So rates go up, multiples compress. Isn't that how it works?
Well, that's assuming the stock has a multiple. So I'm thinking, as we're having this conversation, I'm thinking back to a few months ago when we were talking about, is the market euphoric? And I said, I would argue that the market's not euphoric, but there's lots of pockets of euphoria in the market. And I think that that's what we're seeing right now. We're seeing those pockets that were totally euphoric, that were bubbled. We're seeing them rationalize. We're seeing them reconcile their valuations. So I think you're right, Scott. Yes, an increasing interest rate can take away multiple points. But what happens when you have something that has no multiple because it's got, negative $2 or negative $3 a share of earnings? How do you deal with those? And I think that's that's one of the reasons why we're seeing this, let's call it high-flying tech stocks get really slapped right now because they were coasting on fumes, and those fumes are being taken away. They've essentially been driven up on free money. And guess what? Money might not be free anymore, and money might not be pumped into the economy at the rate it was. So all of that's at play coming out here. And I think that's what's starting to really reconcile the prices. I don't even want to say the valuations because there are no valuations. All of these high flyers, they're all trading on kind of assuming that they're going to capture 100% of total addressable market, total addressable market. And they can't all capture that. So they're deflating. They deserve to deflate. They got chased to higher prices that were irrational. And let's not forget, many of them are still up 200% and 300% over the last 52 weeks. So to me, saying, are they at bargain prices now? No, just because something's not at its high doesn't mean that it's suddenly at a bargain. They're still up a tremendous amount, and I think they still have a long way to come down.
A lot of these are, at least a third or so off of their record highs. And that brings me to Degas. You're in Apple, you're in Amazon, down 2.5% and 6.5% respectively this week. You're in NVIDIA, down 14%. Tesla 18, PayPal 13. What are you doing?
Yeah, so Scott, if Vin can put up the NASDAQ 100 chart, just wanted to look at that for a moment. If you notice that the high point was around February the 12th, and since then the NASDAQ 100 is declined 10%. So what is this telling us in that? If you hold only the NASDAQ, all those stocks that you just mentioned, the technology names, you're going to suffer through this period. What we really see as investors is to be diversified. And what we do is that we look at those disruptive companies, a Tesla, a NVIDIA, for instance. We have to expect in these markets, when the market declines, interest rates are increasing, we can expect those disruptive stocks to decline also sharply. However, that does not make up the bulk of our portfolio. The bulk, it makes up roughly 5 to 15% of the portfolio. But then you look at the growth stories, and those growth stories are going to be around those free cash flow, positive free cash flow. Companies like Oracle, MasterCard, for instance. And so that makes up the bulk of our portfolios, anywhere from 40 to 60%. But then you have what we call the infrastructure companies, and these companies are the ones that have been doing really well during this period, and they could be anywhere from 10 to 30% of your portfolio. And so these are companies like Illinois Toolworks or Quanta. So you want to look at your portfolio as many different members, and you want to break it up into those three groups. And if you do that, you can take these periods of declining disruptive stocks because you have the infrastructure stocks that are going to hold up the performance of your overall portfolio.
Yeah,